Guess I'll start, everyone. I'm Alexis Wood, graduating senior at Furman University and a JD candidate for UNC Law next fall.
And I'm Johnny O'Leary. Pretty similar situation to Alexis. I'm graduating as well, and I'm also going to law school, although undecided at this point. And yeah.
And I'm Diana Oxner, and I am a junior, so to be determined.
And so we're all members of the Riley Institute's advanced team. So that's basically a group of Furman University students interested in government and public policy. And unfortunately, we can't be on campus right now to hear speakers that we actually bring to campus. However, the Riley Institute, we're inviting past speakers into our own homes so we can get informed on their perspectives of COVID-19 and its impact on the many dimensions of our lives.
And today we're doing one of those. And so we're talking to Eric Spitler, who is an adjunct professor at the University of North Carolina School of Law, where he teaches a class called Legal Response to Financial Crisis. He also has a consulting firm, Delverton Strategies, that focuses on financial regulatory issues. And Spitler was the director for the Office of Legislative Affairs of the Federal Deposit Insurance Corporation, or the FDIC, for many years, including during the 2008 financial crisis known as the Great Recession. He has frontline experience helping rebuild the economy in a time of crisis, and he's also a Furman grad. And we look forward to asking you a few questions today.
Mr. Spitler, thank you so much for taking the time to talk to us, and we hope that you and your family are happy and healthy and are safe during this time.
Thank you very much for having me. It's great to be with you. We are, and I hope all of your families and all of you are healthy as well. It's a very unusual time, I think, for all of us, and I don't think any of us expected our spring to be quite this way, but I really appreciate the opportunity to connect with Furman during this time.
Yes, so now we're going to get to the questions. So the first question we had, I think that many people are kind of wondering how this will play out, is how is the current economic crisis that we have driven by COVID-19 similar to what we saw in 2008 with that financial crisis?
Well, that's a great question, because while there's some similarities, there really are some very significant differences between the two crises. And that's going to require different responses going forward. So the 2008 financial crisis was more of a crisis of confidence. It was caused by unsustainable mortgage lending. It was a complex chain of events where financial institutions made loans to borrowers who couldn't afford to repay them. Those loans were securitized, they were sold to investors, they sort of moved through the entire financial system. And when the real estate market went bad, people lost confidence in the value of the assets, and credit dried up in the system. In essence, it was like the financial plumbing that supported the economy froze up, and you couldn't get credit to people who needed it to run their businesses and to buy things in support of the economy. And so the solution in 2008 was, had to be focused on restoring confidence in the system, getting credit flowing again, and demonstrating that the government would support the financial system. And ultimately, that was successful in sort of freeing up the economy. This time around, this crisis is much easier and much simpler to understand than in 2008. Instead of a long chain of things feeding off of each other, here you have an international pandemic that is requiring people to maintain social distancing. Businesses are closed. There's no revenue for businesses, no income for lots of people who've lost their jobs. So instead of it really affecting the plumbing of the financial system like in the last crisis, this one's is more like the hurricane tore the roof off the house. The plumbing is still there, but the house isn't really livable at the moment. And so the differences in two crises mean you have to approach them in two different ways. In 2008, the goal was restore confidence in the system, get credit flowing again. This time around, what policymakers are really trying to do is buy time. They're trying to sustain individuals, they're trying to sustain businesses during this period of social distancing and bridge the gap so that they can pick up quickly, hopefully, where the economy was when things can reopen. I mean, the stores will still be there, the infrastructure will still be there. What we're missing right now are people. And so the hope is, you know, the sooner we can get folks back, the better. But in that interim period, to try to reduce the damage as much as possible. And that's really what you're seeing. Congress, the Federal Reserve, they're making trillions of dollars available really to fill that gap between when everything shuts down and when everything can reopen. And the real challenge is, how long can we sustain the effort? How long can we continue to do it? Is the effort being properly targeted? Will it be adequate to avoid long-lasting financial damage? At some point, you do run a risk of this crisis, pandemic crisis, metastasizing into a financial crisis. We're not there at this point in time, but you know, if people can't pay their mortgages or they've lost their jobs and can't pay their bills, at some point that begins to feed through the financial system. And I think a large portion of what folks are trying to do right now in terms of policymakers is to try to push that time off as long as possible so that hopefully we can avoid the worst of it. And that's why you're seeing these unprecedented efforts. I will say one big difference that you're going to see between this crisis probably and the last crisis is this one's going to be a lot more expensive than the last one was. And in the last crisis, most of the actions the government took were based on credit. They involved loans and lending. And so most of it got paid back. In fact, the vast majority, certainly all the money that went to financial institutions got paid back. Most of the money that went to the auto industry got paid back. But this time around, there's a lot more direct payments going to individuals and businesses, a lot more grants. That's money that won't come back, won't be paid back. And so this one's going to be more expensive. And so it's going to linger with the economy probably for longer than the 2008 crisis did.
And just to kind of follow through on that, what is the actual prospect of a financial crisis emerging in the aftermath of COVID-19?
As I mentioned earlier, it really depends on how long it lasts and how effective the response is. The longer it lasts, you see people starting to not pay their mortgages, not pay their credit cards, car loans, defaults, bankruptcies. That's still ways off. We haven't really seen that start to spike as much as we expect. We are seeing the unemployment numbers go up at record levels. Hopefully, most of those will be temporary. And a lot of what the targeted government response is designed to do is to make it possible to support those unemployed folks as much as possible and leave them in a position, leave companies in a position where they can rehire as soon as we're able to reopen. It's a difficult mix to do. It also depends on how effective the aid being given. Is it being targeted at the right places? Is it enough? Is it enough to keep the necessary infrastructure and financial underpinnings supported? So far, we're not seeing the kinds of strain in the financial system that we saw in 2008. I mean, logically, you look at it down the road, if this were to go on for an extended period of time, we'll start to see some of those strains. But right now, most of it is seems to be operating fairly well. In fact, for example, the banking system is being used as the conduit to get out the payments for the payroll protection program. And so we're not seeing the sort of meltdown in the financial system, in the financial plumbing that we've seen before. Banks can still lend. They do have credit available. Credit is flowing through the system, but it's a shock to the system, and things are holding together at this point. But the longer it goes on, and it may require more support. It may require additional sectors of the economy receiving support who up till now have not received a whole lot. So it's going to be, I think everyone's goal is to avoid exactly that. The Fed and others and Congress are certainly trying to avoid a financial crisis growing out of this, to keep this as a crisis that's wrapped around the pandemic as much as possible. I mean, that's certainly bad enough. You don't really need a financial crisis on top of that. And so a lot of what you're seeing the Fed do is geared toward avoiding a financial crisis, or certainly delaying as much as possible the point in time to which we would get to see a strain in the system.
And you mentioned Federal Reserve earlier. Could you explain the role of the Federal Reserve changing with this current crisis, and in the future, how do you think it will be?
Sure. So the Federal Reserve exists to be the lender of last resort to the financial system, but generally that lending's been restricted to the financial system. What we're seeing now is they're lending directly to industry sectors as well. And so that's a much more direct intervention in the economy than the Fed historically has engaged in. It is, they're being very aggressive about it. I think they've created something like 9 separate lending facilities, all of which running into the billions, hundreds of billions of dollars. It has special authority under Section 13.3 of the Federal Reserve Act. It's a power that really had never been used before 2008. But in 2008, they used it to some extent, but we're really using it this time around. Interestingly, after the 2008 financial crisis, Congress actually limited the Fed's ability to use its 13.3 powers to say that you can't use it for individual companies like the Fed did with lending to AIG in the last crisis, that they all have to be programs of broader applicability, and they need Treasury's concurrence to do it. This time around, Treasury and the Fed have been working very closely, so concurrence wasn't an issue, and they've been using that 13.3 power very aggressively, creating wide-ranging programs, but those programs often lend and let people use different types of financial instruments as collateral. And this time around, the business loans and types of lending that you haven't seen in the past for a Fed facility, or the Fed's being much more willing to accept those kinds of loans to keep things managing and operating. And so the trick's going to be that the Fed is going to come out of this with a huge balance sheet. They're lending against a lot of collateral. They're taking onto their books a whole lot of different types of financial instruments. And the tricky part for them at the end of all of this, much as it was after 2008, in 2008 they did the same thing. And then they started to try to unwind this and get these financial assets back out, so they're not being held by the Federal Reserve, not being held by the government. That's a very delicate, tricky thing to do. They were in the process of still doing that from the last crisis when we hit this crisis. So they're going to have a very big balance sheet. It's going to be a real challenge for them to try and move those things back into the economy, so that they can step back out of their support for the economy as things improve and as we recover. But that's going to be the most difficult part, probably, that the Fed will have. And its role now is just that it's playing a much more central role in the economy than it ever has in the past. And that's going to be a real challenge for them. They don't like to be front and center this way and have this much reliance on them. And so I think their goal and hope will be get the economy back and recovered, so that they can step back into their more traditional role going forward.
And that's a really nice segue into the next question. I think you touched a little bit on it in the last couple of things you said, but given the proximity to the Great Recession and the financial crisis of 2008, do you think we're better prepared to help to better handle the potential ensuing financial crisis because of its proximity? Or do you think there's anything kind of lingering from the Great Recession that's going to impede our ability to respond to the COVID-19 potential financial crisis?
All really good questions. I don't think there's any question we're in better shape than we were going into the last crisis. One of the things coming out of the last crisis that banks in particular, the federal regulators required banks to increase their capital substantially over where we were. So the banks were much better capitalized coming into this crisis. They'd had several years of good earnings. They were just much stronger in a better position coming in than they were the last time. They've also been large banks every year since the crisis. Regulators have put them through what they've called stress tests. And every year they would require banks to say how they would perform if certain economic variables changed. And frankly, the stress tests have always been pretty stringent. They weren't quite what we're dealing with now. But because they had to go through that, because they had to prepare for that, because they had to justify it, if they didn't meet the stress test in any given year, they could be restricted from paying dividends. Some were. So they've taken it very seriously over the last decade. And the stress tests have really helped them, that along with business continuity operations, which they had to improve frankly, after 9/11. There's just a whole lot of different pieces here that have put the banking system, at least the financial system, in better position than it was going into 2008. It's stronger. The hope is that they can continue lending through the crisis, that they can work with their customers to get over the hump. As I mentioned, they're actually being used at this point in time as a conduit for the payroll protection plan payments going out to small businesses and companies in the country. So it's overall, we're in a much better place to be starting this. It's also clear, though, as you asked, that there's some unfinished business from the 2008 crisis that probably needs to be addressed in the future. The mortgage securitization industry is one area of the financial system that is seeing stress right now. I mean, as people forbear, as people don't pay their rent, that is feeding through into mortgage securitizations, companies that take money from the mortgage payments and pay them out to investors. They have a contractual obligation to pay them out to investors, but there's no money coming, there's not as much money coming in for them to make that payment. And so they're in a place right now where they're going to need some kind of assistance going forward, probably to bridge the gap. That clearly is an area that as much attention as was paid to the mortgage securitization, that's an area that's probably going to need continued look. And at that point, we still had Fannie Mae and Freddie Mac in conservatorship, and so that's an area that will need to be addressed. Another area that is money market mutual funds. There are accounts that are much like bank accounts, but they pay slightly higher rates of interest, but they're not insured. And they had a run risk in the 2008 financial crisis, and the government had to step in. The Fed has already stepped in, and the Congress has already stepped in this time to support them again. And so that's another area that probably needs to be examined to going forward. So all of this is, they're in better shape. They're not in a condition, nor would anybody be, to be able to sustain this for a really extended period of time. But it's going to be a very tricky balancing act because the reopening has its own issues as well. Because if you reopen too soon, first of all, folks aren't going to be willing to go back to restaurants and wherever until they feel safe. You could very easily get another curve of infections, and having that repeat over and over can be more harmful, just as harmful to the economy, because that's going to push the recovery out farther than trying to sort of take the medicine all at once right now, as painful as that is. And so it's going to be a very delicate balancing act going forward. But at least for now, a lot of the work from the last few years seems to have paid off on the financial side, and hopefully we'll all be able to get past this in the relatively near future. We'll have some probably lasting impact, but hopefully once things reopen and people can get back to work and companies can rehire and the money starts moving through the system, the financial system hopefully will be ready and waiting to support that activity as the money starts to move through the system again.
And off of that, I wanted to ask a question before we run out of time about universal basic income. Do you see more political debates of that, with people just seeing how a lot of people were struggling during this time, in the future people arguing for a basic income in the US?
Well, putting on my hat from my time as working with Congress, I think politically that's going to be a very difficult lift going forward. It's something actually, frankly, that I think some people in both parties are thinking about in terms of in the crisis time, that as I talked about, as a vehicle for perhaps bridging the gap. But memories are short, and once we're through the crisis, I think it would be a big debate to have that kind of support. Where I do think you may see more attention paid would be, especially if we see multiple waves of this or regional impacts from this, might be more on sort of a different ways of providing income support during crises, similar to whether it's a pandemic or a natural emergency, a natural disaster or something like that. But as for sort of the universal income, that's a huge lift for this country. It would move in a different direction than this country's been for a long time. And so I think you would, given the sort of partisanship we have right now and the deep divides we have in this country right now, I think that would be it would be a heavy lift for Congress to do at this point in time.
Well, Mr. Spitler, we really appreciate your insight and time. Thank you so much for spending a little bit of your Wednesday with us. And I hope that you and your family take care. Do you have anything else that you want to say before we end this?
No, I just, I know it's been tough for all of the seniors and all of the students at Furman, and I wish you all well. And I know remote learning is not the ideal way to do it, but I commend you for having the creativity to think of things like this call and a number of other ways that I know you and the faculty are working to continue to learn even while you can't be on campus. And I think we all look forward to the day where we can all be back on campus soon.
Absolutely. Thank you.
Yeah, thank you so much.
Yes, thank you.
Thank you.